Could the next 3 months decide the future of the entire crypto market? Macro investor Raoul Pal believes we're standing right before a tsunami of capital that could rewrite how we think about crypto cycles. He sees a once-in-a-generation expansion that will take crypto from a niche market into the core of the global financial system. While most analysts are still arguing about short-term price targets and if the cycle is about to top, Pal is focused on something bigger. He sees the perfect alignment of 3 forces: liquidity returning to the system, technology moving at exponential speed, and digital assets maturing into a new asset class of their own. To him, what's coming isn't just another bull run because it's the beginning of a financial era built on blockchain. And the timing couldn't be better. October has arrived and both Bitcoin and Ethereum are already pressing against their all-time highs. Historically, this is the stretch when crypto performs at its strongest. October and November light the fuse, and the first quarter of the new year delivers the explosion. In this video, we're breaking down exactly what Raoul Pal sees coming next, how Bitcoin and Ethereum's historic patterns line up perfectly with his macro thesis, and why the next few months could be the start of the biggest wealth shift any of us have ever seen. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's begin. October has always had a reputation in crypto. It's the point in the year when Bitcoin starts moving with purpose again. Markets are waking up after months of quiet trading, and both Bitcoin and Ethereum are sitting right under their all-time highs. Traders call it Uptober for a reason, not because it sounds catchy, but because the numbers keep proving it true. If you go back through Bitcoin's history, this is the time of year when momentum builds. From 2013 to now, October ranks near the top for average monthly performance. It's when new capital begins flowing back into the market and short sellers start to get squeezed. But the real story doesn't stop there. The month that follows has been even better. Across every major cycle, November has delivered the strongest gains. It's the period when long-term holders stop selling and new demand overwhelms supply. That shift has triggered some of Bitcoin's biggest breakouts. In late 2017, that move took Bitcoin from a few $1,000s to the edge of $20,000. In 2020, it was the same story: steady prices through the summer, acceleration in October, and a parabolic run through November. The pattern repeats because the drivers behind it don't change. Year-end positioning by funds, stronger liquidity from central banks, and the simple fact that Bitcoin's supply growth keeps getting smaller. It's a setup that compounds every 4 years after each halving. This cycle fits the same structure. The halving has already tightened supply, ETFs are quietly absorbing daily issuance, and the macro backdrop is turning supportive again. The ingredients are in place. That leads to the next question: what happens after the calendar resets? Most people assume the rally ends in December, but history says otherwise. When the new year begins, Bitcoin has often accelerated instead of pulling back. CoinGlass data shows that the first quarter, January through March, has been its second best quarter on record, averaging gains of more than 50%. Those are not isolated events. Q1 in 2017 was the launchpad for the run to 19,000. Q1 in 2021 sent Bitcoin from 30,000 to over 60. Each time, the story was the same. Q4 builds momentum. Q1 delivers the blow-off move that defines the cycle. That's why the next few months matter more than any short-term correction. We're entering the stretch that has historically produced Bitcoin's largest returns. The price structure, the timing, the liquidity conditions, they all line up again. This period between October and the end of Q1 has always been the inflection point. The data says it, and the behavior of large investors confirms it. Institutions don't sell into strength here, they accumulate, they use every dip to add exposure because they understand what comes next. Bitcoin's strongest quarters aren't driven by hype, they're driven by the math of limited supply meeting new waves of capital. That same pressure is building now. The daily issuance rate is lower than it has ever been. ETF inflows are consistent, exchange balances keep dropping. It's the same combination that sparked every major breakout before, only now the scale is bigger. Bitcoin isn't a niche trade anymore, it's becoming part of the financial system's core, and every rotation of capital toward hard assets pushes it higher. Q4 and Q1 together tell a simple story. October brings the first push, November amplifies it. The first quarter of the new year has the potential to finish what the final one started. Every data point says this stretch has been the sweet spot for Bitcoin's performance, and there's no reason to believe this time will be any different. Ethereum has built a reputation as the asset that follows Bitcoin's lead, but when it moves, it often moves harder. The same seasonal rhythm applies, only amplified. When Bitcoin rallies into the end of the year, Ethereum tends to surge during the first quarter that follows. The numbers are clear. Since its launch, Ethereum's best quarter has been Q1 with an average gain of more than 70%. That's where it usually outperforms everything else. It happened in 2021 when Ethereum climbed from around $700 in January to over $4,000 by May. It happened again in smaller bursts through 2023 and 2024 whenever Bitcoin broke new ground. The relationship hasn't changed. Bitcoin opens the door, Ethereum runs through it. The reason comes down to structure. Ethereum isn't just a token, it's the foundation of the on-chain economy. When capital returns to crypto, activity on Ethereum spikes. That means more transactions, more fees, and more Ethereum burned under its fee system. The network becomes deflationary when usage rises, reducing supply while demand increases. Add the growing amount of Ethereum locked in staking and you have a market that tightens with every rally. Right now, nearly 1/3 of all Ethereum is staked and that number keeps rising. Each new protocol or layer built on top of it adds another source of demand. Upgrades to scaling solutions are also cutting transaction costs and expanding the network's capacity, making it easier for new capital to flow in. Every improvement compounds Ethereum's role as the settlement layer for the digital economy. When Bitcoin drives attention back to crypto, Ethereum becomes the main beneficiary. Liquidity rotates in its direction because it offers leverage to Bitcoin's move and exposure to everything being built on-chain. That's why its strongest quarters follow Bitcoin's breakout. The same forces that push Bitcoin higher pull Ethereum up with even more force. Looking ahead, the setup for Ethereum heading into the first quarter is stronger than it has been in years. Staking continues to absorb supply. Layer 2 networks are expanding faster than ever. Developers are preparing for another major scaling phase that could make the network more efficient and accessible. Meanwhile, speculation around an Ethereum ETF adds another potential demand driver. All signs point to the same conclusion. If Bitcoin leads this market into a new all-time high, Ethereum will take that momentum and extend it. Its historical performance in the first quarter, combined with its evolving fundamentals, makes it the most likely candidate to outperform once the next leg begins. Next up, Raoul Pal explains how this rally fits into the much larger trend shaping the future of crypto and global markets.
What we're trying to do within XPAM is capture the trend move from $4 trillion of market cap today to $100 trillion. That won't all be driven by Bitcoin. In fact, Bitcoin dominance over time will change. We're trying to capture the mega trend. That mega trend is so powerful because it's how you unfuck your future. Now, if you look at all of the assets on this table, what we've got is everything in orange here underperforms the debasement of currency. So you're actually getting poorer by owning small caps, REITs, treasuries, preferred, high yields, investment grade bonds, everything, unless you're using leverage. There's only a few. The SPY, well, really that's in line with debasement plus inflation. So when we're looking at those, you've actually only got two asset classes, technology stocks and crypto. And within crypto, you've got these ridiculous returns where Bitcoin since 2012, we didn't go 2011, we didn't go back to 2010 or 9 because the numbers get too stupid, has annualized 130% with that 64% drawdown, 73% drawdown, and 56% drawdown. Ethereum is doing about the same, about 133%, and we expect it to outperform in this cycle as it has done in all of its cycles over time. And Solana is currently, because it's newer in its adoption model, has been outperforming Bitcoin. And then if we were to add SUI in here, which Julian and I are heavily invested in, that has outperformed Solana because it's earlier in network adoption, where you get the steeper part of the adoption curve. So really speaking, there's not many assets to own unless you want to fuck your future personally. So when you want to unfuck your future, you start to think about, okay, I've got crypto and NASDAQ. And I know a lot of you right now are all trading um, tech stocks because Bitcoin's been in this kind of sideways chop period. So you're all piling into tech stocks. Julian and I have tons of them in the portfolio. We love the technology trend. It's a really easy trade, has been an easy trade. But if you're honest with yourself, if you were to own one or the other, then you find that the NASDAQ has underperformed Bitcoin by 99.94%. What is the point of owning any other asset? This is the supermassive black hole of assets, which is why we personally are all in on crypto, because this is the big one. This is the greatest macro trade of all time. This is why many of the greatest macro investors of all time have moved across to crypto, because it is such a powerful trend with such powerful returns, and the cyclicality makes it also tradable. It's also the most powerful, the greatest macro trade of all time, because it's driven by network adoption.
Raoul Pal doesn't see crypto as a niche asset anymore. To him, it's the foundation of a new financial system forming in real time. Right now, the entire crypto market sits around $4 trillion. That sounds massive until you compare it to traditional finance. Global equities are worth over 100 trillion, and the bond market is worth twice that. Pal believes crypto is on track to close that gap. His view is simple: every major technological revolution eventually gets reflected in market capitalization, and crypto is still in the early stages of that process. The comparison he draws is between now and the early 1990s internet. Back then, only a few million people were online, and the total market cap of all tech companies combined was tiny. By 2000, the internet had gone mainstream and tech valuations had exploded. Crypto, he says, is at the same inflection point. Network adoption is accelerating, the technology is improving, and capital is slowly waking up to the scale of what's being built. The difference is that this time investors can directly own pieces of the network itself through tokens. That creates a feedback loop that didn't exist in the early web. In his framework, the growth from 4 trillion to 100 trillion is not fantasy. It's a reflection of exponential adoption. Every cycle, the user base of crypto doubles or triples. Every wave of innovation, from Bitcoin to Ethereum to Layer 2s and real-world asset tokenization, brings new capital and new use cases. What took the internet 15 years to achieve could take crypto 5. The reason is that this industry sits at the crossroads of finance and technology, two of the fastest scaling systems on Earth. Pal ultimately believes that fiat currencies and traditional investments are being eroded by inflation and debt. To protect wealth, investors need exposure to assets that not only keep up with debasement, but grow faster than it. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. When Raoul Pal compares asset classes, his table is clear. Bonds, real estate, and small-cap stocks have all underperformed the rate of currency debasement over the last decade. Even the S&P 500, once considered the safest growth bet, has only just kept pace. In other words, most assets are making people poor in real terms. Only two categories have consistently beaten that trend: technology and crypto. The logic behind it is simple. Every era has an asset that captures the productivity boom of its time. In the industrial age, it was commodities and railroads. In the digital age, it was tech stocks. In the age of digital networks, it's crypto. Bitcoin and Ethereum have grown at compounded annual rates above 100% for more than a decade. Those returns are volatile, but they tell the same story. Nothing else scales with the speed of innovation like crypto does. Bitcoin has averaged roughly 130% per year since 2012, despite multiple drawdowns of 50 to 70%. Ethereum has done about the same, averaging 133% annually since launch. Both outpaced every major index on Earth. Even during correction years, they rebounded faster and climbed higher. Pal argues that this is not randomness, it's network adoption expressed through price. He also points to what's happening with newer networks like Solana and Sui. They're younger and earlier in their adoption curves, which is why they've been outperforming in percentage terms. Each new network goes through the same pattern: flat growth, explosive expansion, then consolidation. These are not isolated bubbles but repeating phases of technological monetization. That's why Pal calls crypto the supermassive black hole of assets. Everything eventually gets pulled into it. For him, this is why many of the world's top macro investors have shifted into digital assets. It's the one trade that reflects both scarcity and innovation. Tech captures growth, Bitcoin captures scarcity. Together, they hedge against the two biggest forces shaping markets: inflation and disruption. That combination is rare, and it's why Pal believes crypto and tech are the only asset classes worth owning long term.
Everybody mid-curves this. This is total internet users in millions from 1992 when there was first 5 million users of the internet, and crypto users 2016 when there were 5 million. Now, we use active wallets as a proxy versus active IP addresses. Are they perfect? No. We all have lots of wallets. We all have lots of IP addresses. It is the direction and the rate of change that matters. The internet grew at 76% a year and then started flattening down to about 43% a year. That's very typical of network adoption models. Crypto has been growing at twice the speed of the internet. We will have 1 billion active wallets, and we can proxy that for active users. Yes, there's less active users. I get it. Doesn't matter. Don't get caught on mid-curving it. What it's saying is it's growing twice the speed of the internet. This is the fastest growing technology in all human history up until AI, which is dwarfing it already. But the difference between AI and crypto is you can't own crypto. You can't own AI very easily. And you couldn't own the internet. But here, you're getting a token in the infrastructure layer of the entire new internet, which is blockchain. And blockchain is not just about Bitcoin. It's not just about Ethereum. It's about all of the use cases of these various chains. We've seen the same with cloud compute, and that's split amongst tons of companies. Yes, there'll be some giants. There'll be some fast adoption. There'll be new use cases. It's all coming. And don't forget, here we're still in the speculation plus stablecoin phase. We haven't started really putting real world assets on chain. That's coming. We haven't even started putting Web 2 into Web 3. That's coming. That's a mega trend. That'll suck in the next rise, which is by 2030, we think we get to half the world's population having crypto wallets.
The numbers back up his confidence. The internet grew at about 70% per year in its early decades, then slowed as it reached maturity. Crypto's growth rate has been nearly double that. Since 2016, active crypto wallets have increased at an average annual rate of more than 150%. That puts it ahead of every major technology adoption curve in human history. Using active wallets as a proxy for users, Pal projects that crypto will hit 1 billion users by early 2026. That's the same milestone the internet reached in 2005, but crypto is getting there in half the time. This speed of adoption is what makes the growth to 100 trillion possible. Each new user brings capital, innovation, and demand for infrastructure. Every wallet is a potential investor, developer, or participant in the on-chain economy, and the growth is just beginning. Most of the current market still revolves around speculation and stablecoins. Real-world assets, bonds, equities, real estate are only starting to move on-chain. When they do, the scale of capital entering blockchain networks will dwarf anything seen before. That next wave includes tokenized treasuries, on-chain credit markets, and corporate tokenization of intellectual property. These aren't future concepts, they're already being tested by major financial institutions. Pal points out that this is where crypto's structure becomes powerful. Investors can own a piece of the infrastructure that powers this transition. You couldn't own the internet itself in the 1990s, but you can own the protocols building Web3 today. That means every phase of adoption feeds directly into value accrual for token holders. The crypto market has gone through 3 stages so far: speculation, stablecoins, and early decentralized finance. The next stage, tokenization of real-world assets and full Web3 integration, will be the biggest by far. Pal expects that by 2030, half the world's population will have crypto wallets. That's more than 4 billion people connected to a digital financial layer built on open blockchains. Even AI, the fastest growing technology in history, doesn't offer this kind of ownership opportunity. You can use AI, but you can't easily own it. With crypto, you can own the base layer. That ownership model is what gives it the potential to expand far beyond a niche investment into the largest market transformation in decades. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.